Welcome to today's episode of Slash Tax, where we uncover smart strategies to slash your tax bill, unlock incentives, and invest strategically to build wealth. I'm your host, Heidi Henderson, and today we're exploring a fascinating out-of-the-box investment opportunity that combines tax strategy with the magic of the movie industry. I'm joined by David Scott, who is the managing partner of Scott CPAs, a California-based family-run CPA firm, along with John Lankford, who is the founder of Three Legends Entertainment. David and John are not only brother-in-laws, but they have formed a powerful partnership that merges strategic tax consulting with film production investments. So this really unique collaboration offers accredited investors and high-income earners a way to diversify their portfolios, participate in the excitement of the movie industry, and enjoy some significant tax benefits at the same time. If you've ever wondered how to make your investments work harder, not just through returns, but through real tax savings, this episode is a must listen. So let's dive in. So after that introduction, John, David, thank you so much for joining today. I'm so appreciative of you guys being on the podcast and looking forward to diving into both of your areas of expertise.
You're welcome.
Thank you, Heidi.
Okay, so kind of fun. You guys have an interesting background. So, David, you are the founder of Scott CPAs, correct?
Well, actually, my father founded the company, but I am the second generation with my brother as the partners.
Okay, that's fantastic. So it's a fun family-run business.
Family-run business, yes, and it's grown over the years. It was founded in 1979, and we've grown significantly over the years. Yes.
Amazing. Well, that's pretty cool. It's fun because I always talk about the fact that I work with my sister. She's one of the partners here at our company, and I've worked with her now for about 16 years. So it's always interesting with family dynamics, but it's amazing when you can make that work.
Yes.
Very cool. So then that brings into the equation John, and John is actually with Three Legends Entertainment. And John, how did you end up as part of the family?
It's my sister is his wife, David's wife. So, I wouldn't say I just ended up there. They met, and there's a whole story behind that, and we became brothers by marriage. But the great thing is that David's actually a really great guy. And it's great having someone that's a brother-in-law that feels more like a brother than someone you have to deal with during holidays and whatnot. So
Well, that's nice. I mean, David, that should make you feel good. And yes,
Hi.
John, I think you're lucky if that's the case.
It does. It does. In fact, one of those holiday meetings brought John and I together on the topics of tax, and I was impressed with John's skill and knowledge in the area of entertainment, and we really bonded talking over the unique opportunities in that industry, and it kind of brought us together at a family event years ago, and
How
here we are
cool.
today.
Absolutely. Well, and that's exactly why we're here. So on Slash Tax, what I love to talk about is just bringing different tax strategies and opportunities to investors, accredited investors typically, or high net worth individuals, looking at ways to continue to increase their family's wealth and reduce their income tax and invest in options that they might find interesting or things that they're passionate about that can also have really nice returns. And so what is really interesting is that, John, you have a really unique background in the film and production industry, right? Tell us a little bit about that.
yeah, so I have kind of a mixed history in entertainment. When I was when I was a teenager, becoming an adult, I got scouted for modeling and acting, and I lived in Northern California. Grew up there. I was born down here, grew up there. And I actually ended up moving down here because I had some agencies that wanted me to give it a try. I gave it a try for about 3 months and then quit. I
I'm sure
decided
that's
I
not
decided acting and stuff was not for me. Not that I didn't do well, just that I didn't really like the actor environment too much, or at least the budding actor environment. But then I started a little bit later in life getting back into it, and I had the opportunity to work on the back end of films, and I worked on a bunch of shows. Beverly Hills 90210, the reboot that they did, Melrose Place, the reboot that they did. I worked on Ocean's 13 that they did in the big studio. I believe it was 16 on the Universal lot. I worked on the show Weeds, Nip Tuck, and many, many more. I also worked with a lot of, in that job, worked with a lot of celebrities, kind of personally, one on one with some stuff that I was doing at the time. And I kind of went away from that a little bit and then got back into it again. And since then, I've been working with a lot of big producers in Hollywood and stuff like that on movie productions, and also kind of side ventures that all of them are involved in as well. So one of my partners, he owns the TCL Chinese Theatre in Hollywood, which is about the most famous theater you can think of when it comes to movies. That's where they do all the big Hollywood premieres. They shut down the Hollywood Boulevard in front. I've seen some really cool kind of setups from that, especially like the Star Wars one. But yeah, and then he also owns the Dolby Theatre, which is where they host all the Academy Awards and whatnot. So I'm involved with helping to produce shows there as well as movies and film.
Wow. Wow. I mean, that is a space or industry, I guess, that is completely foreign to me. So I have no background or really experience in production or filming or movie premieres, other than, of course, watching movies. I think
And you're kind
we
of
all.
doing it right now.
So I'm like, okay, John, I want to go to the next movie premiere. Like, come on.
If you're down here, I will. If there's a premiere happening, I will definitely invite you.
I love it.
Let me know.
Okay. Okay. Put me on the list. But now connect the dots. How does all of that then connect to the CPA world? So David's here as our, in-house expert on the CPA tax side. So connect the dots for our listeners between film production and how this can relate to tax.
So as you well know, that investors and people that are, we'll say, go-getters, are always looking for great opportunities to utilize or to deploy funds, to make money, to ideally have some sort of tax benefit. And generally, they don't just want the tax benefit of spend some money, and if I make a loss, I get a deduction, because that's kind of ho hum. What we're doing in this particular space, due to IRC 181, and there's more to it, and I won't go overboard on the technical side, at least on our first pass. It allows a investor to invest into a film, a certain size film, up to, we'll say, $20 million. It's 15 million in most cases, but 20 million in the right location. And then deduct, or we'll say write off, their investment times a multiple, typically a 3 to 4 multiple, due to their amount at risk in the, we'll say, invested, or there's a term called at risk that they have into the movie, and it allows for a large deduction. I mean, right now, most people are aware of, if I buy an SUV, and now with the big beautiful bill, I can write that off potentially all in one pass, and so that kind of motivates people. But here in the movie industry, is even beyond that. And so for the right investor, you're able to put in $1 and deduct $4 potentially. Now there's a lot to it, but that's really that is a very exciting opportunity. It motivates people to invest in film, and that's one of the United States great outputs, is the film industry. And so we need to protect that industry and invest in United States films.
Wow. Okay, so let's dive into that a little bit because I love getting into the meat of it, and the accountant in me is like, okay, I want to understand these numbers. Why can we invest money into or funds into film production and have a larger deduction? What is the reasoning behind it?
So what they're doing is they're taking their estimated production costs. So when you're putting a film together, it hasn't been necessarily filmed yet, right? So you're an investor generally before the film has actually begun filming, and so they are putting together the cost of the actor, the cost of location, the cost of all the fees based on where you're doing the film at, the costs of just on and on equipment costs, personnel, etc., lighting. And so they have these estimated costs for the film. And then you have additional, we'll say, agreements that you would be involved in as an investor to make sure that all the costs are paid, etc., for into the future. And so you have a large pool of costs that are estimated at the beginning. And so that allows, if those costs are strictly adhered to as far as what the costs are, which they're typically done by a reputable production team, you're allowed, due to IRC 181, to deduct your portion of those production costs as a
We lost
materially
him.
We'll
participating
just pause
investor
there and wait for him to
in
jump
the
back in.
first year. So that is we'll say the appeal of for the investor, that they can actually invest in the movie and then put whatever amount of money in, maintain their role as a materially participating investor, and take a deduction for the amount. The great thing about IRC 181, it allows the investors to be a part of the pool of the estimated costs for the film. And so what that means is, let's say I put in $100,000, or we'll just keep it simple, a dollar into the production. And if there's an estimated cost of X amount that are beyond my dollar, because of there's also additional investors, there's the production development team, etc. I'm able to deduct a multiple of that dollar I put in due to the future costs in that investment. And so when I say future costs, I mean the first year they're not incurring all the costs. They have costs estimated for the entire film production. And so as an investor, I can take a piece of that in the first year with IRC 181. And so similar to when you deduct on an SUV, as an example, just to keep it simple, you're going to have a longer term value of the car for 5 years, we'll say, but
Hmm.
you're able to write it off in the first year. So with a movie, you have these costs that may go over the course of a year or two, depends on how fast they do the film, etc.,
Hmm.
and then ongoing potential costs. And so they're able to deduct those all in the first year, and the investor can take advantage of that. And that's huge. That's
Yeah.
a huge, unique area, because that motivates an investor, because right off the bat, even if the movie isn't successful in the sense of the term of hey, I made a lot of money on it, I am successful just by making an investment in that movie. So it is a unique and special opportunity to support the U.S. film industry, as well as make money on the in the sense of tax savings on the investment, as well as have a big opportunity for a large upside on the movie itself.
Wow. Okay, so you invest in, you become what? I'm assuming you're becoming a limited partner in kind of the partnership that's funding the production.
Yes, yes, we'll say that's true. There's a couple of things. So one, you'd be automatically. How technical do we want to? Do you want me to talk about the passive and non-passive? And
Yeah,
okay,
yeah, let's do it.
so off the bat, so we'll just say there's three types of income. You have ordinary income,
Hmm.
you have capital income, and then you have passive income. And so there's three buckets. Most investors will say would like this to be an ordinary income activity.
Hmm.
And so you have to qualify for that. And it's based on, we'll say, your time put into the activity, we'll say the risk, the amount of efforts, etc. And that's all calculatable. That's all we give. I mean, we as a firm, together, we get together, John and I, help our investors, anybody that's involved in that, to achieve that, to become a materially, or we'll say a participating investor.
Hmm.
Um,
And is this 100 hours? So similar to like a solar credit investment? Would it be 100 hours?
about 500 hours. And
About
so
500.
yeah, so it's about 500. And there's a way of tracking that, et cetera, and the involvement, and we're aware of that. We keep them involved, and John can speak to that here in a moment on the types of involvement that we're gonna give them right off the bat without them even asking, because we realize that. And that is subject to their individual tax preparer as far as their positioning on that, but we would guide them and help them, advise them on that. But so initially it would be passive. So you don't have to be a materially participating investor. You can just do the investment and take it as a passive loss. Now, the problem is it depends on your tax circumstances, and I don't want to bore, I don't know the exact listener here, but we'll say if we get into if I have passive income, passive losses are valuable. If I don't, then they may not be as valuable. That's something that we would speak to on an individual case by case basis.
Yeah, right. And a lot of our listeners are CPAs, tax preparers, strategic tax advisors, and then also a lot of investors that are pretty savvy. So I know we're getting a little bit into the weeds, but we deal a lot with this on the real estate side when we're dealing with real estate investments and how we're handling whether it's a short-term rental, long-term rental, or other activity with business versus real estate, and then handling how do we offset our ordinary income, which most of our investors are really looking, how can we become active to actually offset the W-2 or ordinary income. And you all are based in California, so I'm sure many of your investors, as are ours as well, in a very high tax state where, at a 40 to 50% tax bracket, this can be really pretty dramatic if in fact they can meet the material participation rules. So yeah, that's interesting. But to your point, even if it's passive, it doesn't mean that an investor cannot necessarily invest in this type of a vehicle, but it would only offset their other passive income, right? So does that include any type of any other capital gain situation, other investments like stocks and bonds, or other passive income they're generating? Like, would it offset any of that?
Well, there's limitations on this because this would be a certain type of income, and it
Mm-hmm.
dependent on at the stage, was it ordinary or passive, and that gets in the if they qualify as a materially participating investor,
Mm-hmm.
we will guide them toward being an offset to ordinary income because that's really the goal. Now, as far as it being a passive, that's pretty much it defaults a little bit to passive
Mm-hmm.
unless you show otherwise. And so we've had many of our investors that John and I have worked with. We've helped them guide them to that we'll say a reasonable position of being a materially participating, or I'll just say an MP, for my
Mm-hmm.
lack of being able to say it,
Yeah.
investor. So yes, that's something that's technically looked at on an individual case by case basis, and that's why our first move typically with anybody doing that is tax planning. And we definitely want them to get with their advisor, et cetera, or we will give them the tax planning guidance, at least on that matter, or if they want more, we can help them together. So
Okay. Okay. Perfect. Um, to one other question as it relates to the film incentives, I understand the like the 4x deduction because you're allowed to then deduct the production costs. This actually reminds me also of like oil and gas investments because you can take a deduction for the total production costs, even if those wells are being drilled and everything's coming to fruition. So it creates a large deduction. Are there also credits that apply for film? Because I've heard of film credits before. So I'm curious, like if there's credits or if it's just the deduction for like the cost within the entity.
the answer is yes, and it depends on the state that you're in, that you're doing the films in.
Mm-hmm.
And those are not necessarily for the investor directly. I mean, they benefit the investor, but those are typically the investors that we're working with off like we'll say for the production company, there are credits, there are benefits. The K1 investor, they would get the benefits via their K1, but the actual production company would get the benefits of those production credits.
Got it. Okay. So they're capturing production credits, but the investors ultimately are getting more of the pass-through losses or the active
Pass
losses. Right.
Yes, exactly.
Okay. Okay. Got it. Okay. So now diving into kind of then the second part, John, is it seems to me like my first thought as an accountant It's like, are you kidding? What is the risk of involved in investing in a film, like production of a film that seems so risky with understanding how successful it may or may not be once it actually goes out to production and it goes out to the markets. So talk a little bit about the second part of this. Is this investment play primarily for the tax benefits and supporting the industry, or is there an aspect of this that truly can have a big upside?
Yeah. So, I mean, David kind of spoke to it. You're kind of the immediate benefit is the tax side, right? So you already have a purpose for doing it. You already have your benefit for getting involved. As far as film and risk goes, I mean, just like any business venture or any investment, when you invest into something, you know, it could hit or it could miss, or, you know, there's a lot of factors that play into that. You can make a ton of money, you can make no money. You know, that's kind of how films are too. You make a great film, you put it out there, you know, it could, you know, say it took 5 million to produce that film and it only brought in 2 million in the box office, or it brought in 15 million in the box office and you made a profit. That's always kind of a little bit of a toss up. But um you know, what we do to kind of compensate for that is one, if the movie doesn't do well, like you said, you're already kind of winning. But if the movie does do well, then you have a potential upside of making money off your investment. And then all you have to deal with that once you do make money is dealing with all that extra money that you're making on the tax end. But regardless, yeah, I mean, uh how we kind of eliminate some of the risk with these types of investment is we only get involved with well, we are involved, and then also we bring in other producers, directors, you know, actors, line producers, everybody, you know, across the board that have been doing this for a very long time. They know what they're doing. They put out successful movies. One of my producer partners I work with, Brad Epstein, he was an executive for Disney at Buena Vista Studios. He was an executive for Tribeca Films, which is Robert De Niro's film company. He's produced and in real life, and many other films that have all been pretty successful films in different aspects. And that's kind of what we try to bring to this focal point of IRC 181 investment is to have a qualified and possibly um, successful film attached to the investment that they're doing in the first place. So we bring in qualified people that have been into the industry and you know can deliver on producing a film and releasing a film. And so, you know, despite, you know, the ups and downs of the film industry and whether a film does well or not, um, you can look at both ends and see, okay, right off the bat, I have this benefit, which is great. And then on the other end, it's kind of like a bonus. If the film does well, then I'm making money and now I have to deal with those taxes on all the money I made off that film or whatever, you know. But yeah, there's I would say on the tax investor side, there really isn't so much of a risk. And on the film investment side, it's just kind of a cool thing to participate in and be part of the process of a movie. A lot of the clients that we've brought to it, you know, they're not necessarily in the film industry. They're, you know, doctors, lawyers, you know, investment bankers, you know, company directors, stuff like that, that have never had any part of the film industry ever in their lives besides maybe going out and watching a movie or watching a TV show and all that sort of thing. But now they actually get to participate in a film production and and get to be part of that process. And as we were talking about before with kind of the participation part, um, some of the things that they get from our end from being on the production side is they get, you know, updated on film budgets. They get to see the whole process behind the scenes of what's going on, who are the actors we are talking to and trying to bring onto the film, where's the film going to be shot? We've gone even so far as to invite them out to the set to meet the producers, actors, all that sort of thing,
Oh, that's
because they
fun.
are investors in the film, ultimately, right? They've put money into the film, whether they did it for tax purposes or not, they are an investor. So they get access to all of that. When there's a movie premiere, they'll get invited to that and be a part of that. And it's just kind of a really kind of neat and cool experience. And that risk part of, say, if you're a traditional investor, is kind of eliminated because you're already doing it for a purpose in the very beginning.
Interesting. Yeah, I mean, you're addressing a lot of the questions that I'm thinking of as we're talking. One about participation, like what does that look like? How involved can someone be, or are they allowed to be? There's probably an interesting balance between trying to achieve that material participation versus maybe not wanting people to show up on
Yeah.
set and try to manage actors. So, talk a little bit about how you handle that aspect with investors.
So I would say, I take the approach, or we take the approach, and we're a little bit more open to those types of situations, right? There's a lot of producers out there where they don't even want to see the investor deal with the questions they have, or the input that they put in. But we're a little bit more open and receptive. I think we're more empathetic to the experience side of what this is, besides the tax portion of it. Being involved in a movie, it's an experience, like I said, for a lot of people that have never been involved in that sort of thing, but always wondered or fantasized about it and stuff like that. And I'm certainly mindful of that. And I know a lot of the producers that I work with, and directors and stuff, they're mindful of it as well. So it's kind of a thing where, we want them to be happy, even though they're doing it for tax purposes to begin with, we want them to be happy with the experience itself and get something out of it. So just being part of those events, meeting people, seeing kind of the back end inner workings of how a film is made and stuff like that is a really neat thing. I know it's something for me that I find interesting. And I'm sure a lot of people that have their favorite shows and movies and directors and stuff like that, they're going to find that interesting as well.
Yeah.
And just having the opportunity that takes them out of their, everyday routine and puts them in a situation that they would otherwise probably never have the opportunity to be a part of.
Yeah,
I think
absolutely.
that's a unique experience for investors.
Mhm.
They're not, it's not, or not to diss any other type of tax, strategies, but it's not, they're not going out to visit a oil rig on a, for oil and gas, or going to visit an auto dealerships, for their truck deduction or something like that. This is a little bit more interesting, get to be part of
Yeah,
these events and these experiences that people otherwise wouldn't be part of.
yeah, absolutely. No, it's a valid point. How many investors do you usually have in a project? So, I mean, just give us an example of a recent project you had and how many investors were wrapped up in it.
Right. So we typically try to focus on, they're not cheap movies, they're not studio movies. So on a studio end, you talking about Universal, Disney, all those sorts of things. They'll probably spend, 100 million, $200 million, or even more, a little bit less producing a movie. On our end, we deal specifically with independent filmmakers. And where that separates is a studio, everything is in house, right? All the money comes within. They're not typically taking on one investors or anything like that, because they have their whole corporate structure that they work with, and that's how they make films. We work with independent filmmakers, and we are independent filmmakers. So we deal with budgets that are smaller. We're still able to bring in the same talent, and what typically happens is those big studios will come into play as distributors. So when you see, like, this film was produced by, let's say, Three Legends Entertainment, and it was also, you also see Universal Picture on there. So they're kind of a partner in the picture. The filmmaker is kind of the workhorse. They did all the, they got down in the dirt. They brought on all the cast and crew that's going to be a part of the movie. They got the film made, and now the big studio comes in and helps distribute it to all the theater streamers and all that sort of thing. Um,
Okay.
yeah, so
Interesting.
that's kind of where we focus. And so our films are usually within that $2 to $5 million budget range. Sometimes a bit higher, up to 10 million. We could even, sometimes we have films that have been on slate that have been more into the 40 to $50 million range and stuff like that. But our focus usually is in that range. And with that kind of film, the amount of investors that are involved on the 181 side really depends on um, what those investors uh, are able to bring to the table, right? So if
Mhm.
they say they're putting in $100,000 to handle their taxes, or they're putting in $500,000. We have a certain range within there. So say we have a $2 million film. Say we shoot in a state that gives us a 40% tax credit. So that cuts out, that gives us part of our budget. We go around, we do pre-sales for distribution to theaters, foreign and domestic, and that brings in 20 to 30%. Then we have that additional 30 to 40% that we need to fill through traditional investment. And that's where the 181 investor comes in. So if we have a $2 million film, we only have to fill that, 30 to 40% range. And depending on the investor themselves, how much money they make and how much they can invest, that kind of determines how many investors we need to bring in and are involved. And once that budget portion is fulfilled that we can accept for 181, um, then that's all the investors that we take, and any additional investors we can get involved in a different film project.
Mm. Okay. Um, So, David, this might be a question for you. Yeah, either one of you guys, I guess, can answer this one. But can you provide a direct example of an investor? And I guess, David, maybe pointing to you. I'm looking at like whole case scenario. How would an investor, or again, if we're using a specific example, how an investor has used this as part of an overall tax strategy, and then how that penciled out for them in their specific situation?
Great question. And our approach, typically as from the tax side, is always looking at the taxpayer as far as them being an investor second. So it's we're really trying to protect them on their tax return and get the very best results. As far as an investor example, there's many, but I'll just use one as one of our investors was receiving a lot of their, we'll say, retirement money up front, or at the as they were retiring from a large W-2 situation. They were an advisor. They are an advisor, and they were not aware of this particular tax strategy, and they had a lot of tax to pay. And what usually first pass with anybody that has been involved in this particular one is we try to first exhaust all available means that are on the tax return or near the tax return, we'll say, things that they're already kind of involved in, things they're doing. So first we generally look at that, and then there's the moment of, this is where I'm at for tax. And they owe, some large amount of money because they had received some pension funds that were a lot of large withholding. So they feel like, boy, all that money's gone. And that's when we come in with the ideas that you have, through your various relationships and your own skills, and then we present an idea. And the one that we told them is not on their tax return is the investment in films. And we have had some really excited investors. And so with that investor, they put in, I'm going to say, a little over 100, and they received basically most all of their tax money back. So they multiplied that, and I offhand just I'll say they put in 100. They were going to owe, I believe, 300,000, and they received their tax money back. I don't have the specific numbers, but it was significant, and they were very pleased, and they're looking to do it again. And so Yeah, so that would be an example. One of the things that I did want to mention, so each taxpayer has a different, source of income. So a business owner with a low W-2, you definitely want to do tax planning on because you got to be aware of qualified business income and its
Yeah.
effect on the tax return.
Yep.
So each investor has different things going on, as you well know. So we try to look at that first, and then if it plays out for them, if they have a large W-2 situation, it's really works great. So
Yeah, I
I
think
mean,
that's so important. I appreciate you honing in on that. And then that's something I wanted to point out as well is that, there are a number of different tax strategies, but ultimately it's so important to look at the big picture, understand all of the intricacies for a particular investor and how that all flows down to their personal tax return, because a lot of
yes,
people don't realize that all of these investments in businesses and W-2s and K-1s all end up on the personal tax return ultimately is going to dictate what they're going to owe in income tax, both federal or state, and then building a strategy around that, and then creating, I think, a plan typically diversified with options, and this may be
yes.
an option that fits beautifully in that overall plan. One question as it relates to California specifically. Now, California, I believe, does not follow or allow bonus depreciation. So, how is the particular tax for film production or the deductions on film production handled in California when you compare federal and state?
Well, federal, that's where the benefit is, and so the benefit is because of the amount of tax that, I mean, back to the topic of high net worth or accredited investor. So just due to we'll say the number of on the federal side, it ends up being beneficial once we run the numbers. We run the numbers first to
Hmm.
show that the play out. But excellent point regarding California. Yeah, California, unfortunately, and that's why there's a lot of the films made in, we'll say, in the southeast and different states. Or California. My my god, retake?
Yeah, hang on one second. Let's give it just a second and make sure that it's stabilized. Okay, it looks like we're okay. Okay. Yep. Just start off kind of there where you broke up.
Fortunately, great point on California. Unfortunately, as you pointed out, California does not do the same treatment on accelerated depreciation as Fed, and so we first use the federal benefit, and that's generally enough to say, "Wow, okay, I have a huge benefit here on the federal side alone." The
Hmm.
state side, that's unfortunate for in California, but that's how it is.
Okay, good to know. Yeah, that's always a factor when we're dealing with different states and how tax is going to apply in different areas. And
Yes.
to your point, we're starting to see it. Like I'm in Vegas, we're starting to see they're building a large production studio here in Las Vegas. We're seeing that across the country. I think, of course, Austin is doing a lot of that. We're seeing things in the South. To your point, so it'll be interesting to see what additional benefits are triggered. Is there one area that's ideal? Like John, what is the is it, I mean, I'm assuming there is a state or an area that is now drawing people due to incentives.
Yeah, definitely state by state. As far as 181 goes, as he was speaking to towards the beginning of the podcast, there's a $15 million to $20 million range of money we can take there, and that's that extra $5 million boost is meant to incentivize filming in areas that are a little uh, more under appreciated or involved. So I won't go into that, but there's a little kicker there, extra incentive for investment that we can bring it into a film. But as far as state tax film credits and stuff like that, it greatly varies state to state. Here in California, we actually just passed some film incentives that greatly increased our competitive position against some of those other states that have been doing a great job of luring film productions to their states. So, like some of the top ones are Louisiana, Georgia, New York. All those places have great incentives, like 35 to 40%. Whereas in California, we had about 20 to 25%. and then we had a cap on how much of that incentive could be used, and the number was pretty low. And
Okay.
now they've pretty much tripled that number of available tax credits for productions in California, and they've increased that tax incentive um, to a range that can land anywhere between 35 and 45%, depending on where you're filming and how you're doing it. So it's definitely we're kind of stepping that up over here. The only thing that would say that is a detriment to California above places like Louisiana and Georgia and stuff like that is the cost to produce a film. So your cast, your crew, your dues, all that sort of thing, the cost kind of increases when you go to California as opposed to some other states. So
Absolutely. Absolutely. Yeah. Overhead costs is definitely, I'm sure, there's so many different factors. We see it with insurance rates and just overall cost of living and wages and everything else. So, yeah, those are certainly factors. Um, a couple of last questions. Who would you identify as the ideal candidate? What are where you can really pinpoint, look, if you as a listener have this situation, then this is very likely a good thing to to potentially take a look at.
Um, I'll just start off with that one. So I would say the number one is a person that has interest in their tax situation as far as what else can I do. Like they're not just filing their own tax return typically. This is a person that has advisory team that is looking into the future. They have exhausted all means with their advisor as far as what they can do, and they're open to say, well, what else is out there that I can be a part of, and then that's when the door opens as far as, and we're obviously not just one option, only the film. You can do multiple options. You look at the different array of them because it's similar to it's like buying a stock, right? You might say, well, let's be more diversified. And so there is a way of kind of looking at the risk tolerance, what is the best amount, and then once you find a good option, then you might do it again. And I think that's what we will see, or we do see in the film particular space is, hey, I like that. Let's do it next year. Like, when's the next film coming? And so it actually opens up a door. It's almost like trying a new sport. You end up liking it. You're like, okay, I'll be more involved. And so
Absolutely.
John and I really enjoy this area.
Absolutely. Is there a particular level of income or tax liability where it makes more sense, or where it's like, again, a threshold that would make sense for someone?
I'll just quickly say that it could apply to anyone. The question would be if they're an accredited investor. Like, so
Hmm.
for example, I would say if you have a tax liability, if you're working with a tax liability or you're having a large amount of withholdings, let's say your number is a million and you're saying, boy, I'm paying $400,000 in tax. Those are real reasons to really consider, because that like the large W-2, we'll say a lot of people, let's say in the Wall Street, and they have these large W-2s, but half of it is taken in tax. Those are really people that would benefit immediately to consider some of these alternative options, and then obviously done with a party that is very aware of all the risks that the taxpayer may face, and that's our approach, and that's why we've teamed together as with the production studio with Three Legends and Scott CPAs as an example, so that you're not just too risk averse or too without the care for risk. So it's the combination so that you can reasonably meet the position that you need to achieve both the tax removal of the tax and the investment benefits.
Absolutely. I mean, it's a reason why I've enjoyed meeting both of you and having the conversations. And I think it really, I think it provides a little bit more security, understanding that you have kind of both sides of the expertise. John, you've got this background in film and production, and David, you've got the CPA tax knowledge that can really look at the whole thing. Because that's one issue. You have tax strategy that then is like, well, you need to find an advisor to really understand what it's going to mean or what the potential limitations are. That's actually something we deal with a lot on our side as well with incentives, is having all of the pieces and the right advisors in place place so that you can really look at what is the best situation for you as a taxpayer, and what ultimately the bottom line ends up being. Last question before asking for contact information and all those fun details. Do you have a minimum investment? What is the lowest that you'll take for an investor to come in and work with you?
Yeah, I mean, it pretty much it speaks to what David was talking about with an accredited investor and stuff like that. So, I would say for sure that benchmark that we try to hit is about $100,000 investment.
Hmm.
I forget what the numbers are, and I'm sure David could speak to it better. But once you hit a certain threshold, it just it gets a bit trickier, especially when it comes to the business side and PPMs and all that sort of thing. Handling investors if they're not an accredited investor. So that's usually the benchmark we try to hit with that. And also on the film side, as far as investors go, when we have that investment pool that we need to fill, it's easier if we're not bit and piecing parts of shares of said film production and stuff like that. So we try to keep that number around so that you know Joe Clark is not coming in and has point 0.2 shares of the company and we have 40 or 50 other investors like that. We try to keep it simple. That way we can keep the experience more intermittent and available for participation to an extent. Um, and it feels more of an experience aside from the fact that it is an actual investment and a tax strategy as well.
Yeah.
Yeah.
Yeah, that makes sense. And to your point, yeah, I think that in line with what David shared about, a ideal scenario or ideal situation for an investor, I think those all kind of line up with what makes the most sense. What is the best way for people to reach both of you? And of course, in the show notes, I always include your contact information and website links, but share a little bit about how best to reach out, and then we'll wrap up.
Sure.
Well, you can reach us by phone at 916-722-2524 and ask for David or John, and we will be glad to give you further insights on this topic. I wanted to circle back around really quick as far as the amount on the tax. An example would be if I owe $50,000 in tax, let's say, and
Hmm.
instead of paying that 50, I pay 50 into a movie or 100 into a movie. I wipe that tax out and give additional amount of money back. So I'm making money on the once I determine how much tax I owe. That's kind of how we look at it. How much do you owe, and then what would be a good investment as far as getting them there?
Got it. So you can work with an investor to understand what their tax implications likely are, and then essentially back into what would be the ideal investment.
Yes,
Perfect.
exactly.
Perfect. Love it. Okay, wonderful. Well, David, John, thank you so much again for being on the podcast today. I know our listeners will be interested, and hopefully, we answered all of the typical questions. And we will look forward to working with you guys on future projects, and we'll share your contact details in the show notes.
Sounds good.
Thank you, Heidi.
Thank you very much.
And that's a wrap for this episode of the Slash Tax podcast. Big thank you to David Scott and John Lankford for sharing how strategic tax consulting and film production investments can come together to create win-win opportunities for investors. If you're a accredited investor or high income earner looking to diversify your portfolio and leverage these powerful tax benefits, then check out the show notes for a special link to connect directly with David or John, or feel free to reach out to me directly. Don't forget, please subscribe, leave a review, or share comments. I would love to hear what you think, and share it with anyone else who's ready to combine smart investing with game-changing tax savings. This is Slash Tax, where we help you cut your tax bill and keep more of what you earn. Until next time.